Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon and Jacob McDonough. How are you both doing today?
Doing well.
Good.
Geoff, both of you guys are doing great. Glad to hear it. We hope the listeners are doing great as well. This is the first time you're tuning in with us. Be sure to check out all of our content on the internet. Go to focuscompounding.com to get access to investment write-ups from Geoff. Follow us on Twitter at Focused Compound. And of course, make sure you hit the subscribe button wherever you're listening or watching the podcast here today. Jacob McDonough, who runs McDonough Investments, the author of Capital Allocation. If you are a frequent listener of the podcast, you know him. Be sure to check out all of his content on the internet. You could follow him on Twitter, and you could also check out his podcast, the 10K podcast, on Spotify and iTunes and wherever else you listen to podcasts. I'm going to put all that information down below in the description. So, Jacob, we had you on the podcast to talk about Geico. And you had told us that you were going to go over General Motors. We said, we'd welcome you back on the podcast when you upload or when you finish your series on General Motors. So here we are today. You've uploaded 3 podcasts on General Motors, and you went over the annual reports from 1918, 1920, and 1932. So we're going to talk about it here today. Before we jump into that, I'm just curious, what prompted you to start with these years? I would say these were some major inflection points in, the history of the company. But what made you decide to start with these 3 years?
Yeah, thanks for having me back. I had a lot of fun talking about Geico with you guys last episode. It's I do the podcast, my own podcast, just by myself, so it's nice joining with other people to have more of a conversation about it. And I always love hearing what you guys have to say on these businesses and the time period. So I'd love to come back anytime I do a business that sounds interesting to you guys. Happy to talk. But yeah, this past year at the Berkshire annual meeting, Warren Buffett talked about, he just casually mentioned, recently I was reading the 1932 annual report of General Motors, and he said it was one of the best he's read. So he's read his fair share of annual reports. He seems to do that every now and then, just be like, oh yeah, by the way, I was reading early 1900 report of Coke or GM or whatever. So I assume he's already read those in the past. Maybe he revisits from time to time, but yeah, so that sparked my interest. And then so I started with the oldest one I could find, 1918. And then I read from there all the way through to 1932 and just decided to make 3 episodes on what seemed to be, like you said, the inflection points. And such an interesting time period because the car industry was so new, so much growth. And then by 1932, the Great Depression, which I've always wanted to study more because, it was a tough time and it's legendary how tough it was. But I've always wondered really how companies fared, and GM did pretty well during that period, which we'll get to, but I want to study more and more companies and see how that era affected them anyway. But that's how I got to this report.
Mm-hmm. Yeah, and I'm just curious, Geoff, do you think that Buffett, like somebody just happens to say, hey, Warren, you need to check out the 1932 annual report of General Motors? Why do you think he just happened to be casually reading that annual report, if you had to guess?
I have no idea.
Jacob, do you have any idea? Just think maybe just generally interested in investing in business history, and he's just like, oh yeah, I should, because I do remember him saying that, and it was just kind of off the cuff, and it was like, really? Like, yeah. 1932 General Motors, very interesting.
Yeah, just my speculation is just for pure enjoyment. He likes, I think for fun, he likes going back, studying business, reading about those businesses back in the day, especially the ones that have lasted for so long. I think they own some GM. I don't know if it's his position. It might be one of his investment managers, but if it's a stock he owns or a business he owns, I'm sure he'd love going back in the history too.
So when you are looking for original sources for something like this, right? So I found on the internet myself, some years of annual reports of General Motors, but I did have to email you and ask for 1918. Is that just, researching around, speaking to people, talking to perhaps libraries or archives? I'm just curious because I imagine you had to do that as well when you were doing research for your book, Capital Allocation.
Yeah, it is more difficult than you would think to find some of these reports, which to me maybe seems like there could be a service or me or someone else could help people out by actually getting these reports more accessible. But in this specific case, I know for my book, there was a lot of libraries I went to and a lot of hunting. But for this case, I searched on Twitter. I saw someone kind of tweeted a link like 5 years ago about 1932 annual report for GM. The link didn't work anymore, but using like the Wayback Machine or whatever, you were able to find kind of like the original link. That's where I got that one. And through that kind of same source, there was some other years they had as well. And then for some reason, I think 1918 I already had on hand, and I can't even remember how I got it. I think I had a habit at one point when I would find some of these old ones, just like download it as a PDF just to make sure that, you don't lose it if the website gets taken down, stuff like that.
So yeah, let's jump into it. So I guess to set the stage, and this is probably a good question for Geoff. Geoff, why do you think the automobile industry, especially in these years, were more concentrated in the Michigan area? Henry Ford, I believe, was a native there, but is there anything geographically or strategically you think that led this sort of innovation or high technology to be concentrated in this part of the country, if you had to guess?
I don't have a guess about that. I know from the book, the Alfred Sloan book, he talks a little bit about like working for a company that was supplying to these different car makers early on. And it was like when we talked about the airplane parts, you would get into a production with a car, and most of these they never made many of. And then a few really took off. And so their suppliers moved in to have offices near them and, to supply them. Like I think his company was supplying both Ford and GM in large number. So I think a lot of them that's where you had your supplies and everything there.
And I imagine something probably like close proximity to the Great Lakes to, get to like maybe Ohio or Pennsylvania for steel and other things like that. But yeah, I was just curious if you had any sort of thoughts on that. But yeah, so let's jump into it. So the year is 1918, which is the first podcast that you recorded, the first annual report you went over on General Motors. Ford's Model T came out in 1909, which was a model that was known for its durability and its low cost. It essentially was made on an assembly line. So yeah, let's talk about GM 1918 and what your big takeaways were from this year, Jacob.
Yeah, it was interesting. So, and maybe a little introduction to it. 1918, it was a very new industry still. The modern car was invented in the late 1800s, but even in the early 1900s, there was still very low production. I believe in year 1900, there was only 4,000 cars produced. And Ford Motor Company was formed in 1903. And like you said, the Model T came out in 1908 or 1909. GM was formed in 1908. So by 1918, this was still pretty new industry. And GM, Billy Durant was the founder of GM, and he's a very interesting entrepreneur. And so basically he was in the carriage business for like horse carriages, and he was based in Flint too. So that could be one small reason. There was some large Flint wagon companies, and then you have suppliers to them too. So I don't know if that played a role in any of the switch to the automobile. There was already some companies kind of working on that there. And then also it's interesting just how industries form, where you get some entrepreneurs that stir up some excitement and some people move there, or some people in the area kind of hear about it and get interested and do experiments on their own and all that kind of stuff. So it is pretty interesting. But Yeah, Billy Durant eventually, though, took control of Buick. David Buick started the company, and it changed hands a few times, and eventually Billy Durant got control of it, and he merged it with Oldsmobile to form GM in 1908. And so that was kind of the strategy that Billy Durant followed, was issuing stock to merge a bunch of companies. And they did a ton of acquisitions from companies we would still know today, like Buick, Oldsmobile, Cadillac, Chevrolet, but also parts makers that that drivers would have seen, and even lamp companies like street lamp companies. And as you get later towards the Great Depression, airplane companies and radio companies, and they were heavy on acquisitions, where Ford was more focused on one model. Henry Ford wanted to control the company, very little to no acquisitions, stuff like that. So that's maybe a little background on leading up to this annual report.
Mm-hmm. Yeah, and Ford, they had something like 60% market share during this time.
Yeah, it's really interesting. So I'd be curious to get your guys' take here. But when I study this, Ford's position just seems so dominant. It feels weird saying that now, seeing how competitive and tough the industry is today. And I mean, it was tough from day one. I mean, demand was high from consumers. They loved cars, but supply was huge too, which is a dynamic you guys have talked about plenty on your podcast. But thousands of companies were started, and most of them failed. So you had that aspect. But the ones that survived, I mean, they had some better returns on capital in the early days in most years than you would see today too. But Ford, Ford and GM had very different philosophies in the early days. Ford was focused. By the time they had the Model T out, Ford focused on that one model of car. And by 1921, they had 60% market share, 6-0, on one model. So that'd be like today, not just Ford Motor Company having 60% market share, but like the Ford Mustang or the Ford Explorer having 60% of all cars in existence, which is huge. So their focus, though, helped them like kind of perfect the one car, get it at a lower cost, get scale, which helped them, economies of scale, and get it at a lower and lower cost. And it was still a new industry. So for people to get used to that car, it helped focusing. And then mechanics, today, back then versus today, mechanics knew less about fixing up cars. And so the Model T didn't change much year over year. And they kept producing it for, I think, 19 years. So it didn't change a whole lot through that whole period. So for mechanics to get used to that, it helped lower the cost to drivers. And Ford was very focused on the mission of providing a car for the masses that was at the lowest cost possible, which meant even not giving drivers the option of colors or things like a self-starter versus like a hand crank starter. Whatever was cheaper, that's what Ford was going to put in the Model T. He didn't care what drivers wanted, really. He was going to make the lowest cost car. GM more was diverse in terms of a lot of different models of cars at different price levels, different options for drivers, diversification in terms of like how the engineering could change over the years, because early in the industry, it's tough to know exactly how the product's going to develop over time and stuff like that. So very different philosophies early on, but Ford's focus is what helped it achieve such a dominant position right away instead of spreading itself too thin.
Mm-hmm. Yeah, you talk about like the difference of philosophies, and the lack of model diversity with Ford. I mean, I have a quote right here. Henry Ford famously said, "Any customer can have a car painted any color that he wants, so long as it is black." Right. So they really only made black Fords. And then to your point about like different models and different colors, GM's philosophy, Sloan, he had said, "A car for every purse and purpose," is what he said. And what he meant by that is, just multiple different iterations, multiple different, prices. So basically everybody can have a GM car, which, you could explain, they're able to, or you could say that probably was able, allow them to attract a bunch of different customers to their brand, as opposed to just like the standard Model T car from Ford.
Yeah. And I'm curious, just even present day, when you're looking at a stock, do you do you think anything different of these two philosophies in terms of like focus versus diversification versus variety, or is it really depend on the situation, case by case basis? I'm just curious if either of those two things mean anything to you.
I mean, I think I'd be concerned if the only advantage is a low price. It's a pretty simple advantage, as opposed to like a GM's advantage was pretty complex. And so there's just a possibility that it could fall apart. It did fall apart with lack of scale, right? So you have to keep your scale up, and then doing that is the only way to keep your price down. You also had rapid growth in the industry, which leads to a lot more people having experience having cars. And I think Sloan talked a lot about the used car thing being a problem for Ford, that they didn't really understand that people would buy used cars if they wanted a cheap car instead of buying a new car. And what they wanted in a new car would be variety and all of that. But I mean, I've talked a little bit about it with like Costco or something. It does worry me. You have to stick to that advantage. And there's just so many complexities in that business that I would be worried about a moat like that being able to last. It may last only for as long as there's someone in place to keep it that way, and not so much when people have a lot of different choices. I don't know how many people would pick something on price alone.
Jeff, does this kind of remind you in a way about like BlackBerry and then the iPhone coming out and killing BlackBerry, right? And how like BlackBerry was so much sticking to their guns, and what they're doing, they had just all the market share basically, and then the iPhone comes out and they didn't iterate, they kind of continued on with it, and it was like the boiling frog syndrome. They eventually died.
Yeah, and BlackBerry thought that they took all their share from Nokia, which was dominant before them, and no one thought that anyone could beat Nokia, and then no one thought anyone could beat BlackBerry, and now you have Apple. I mean, the things that's hard to realize, and you've done a lot of reading of this, Jacob, is just like some of the things they acquired that turned out to be worth nothing. Sometimes that's because that sort of didn't become the prototypical way of how cars were made. But it's at the time you wouldn't have known that. It wasn't all just, we didn't know exactly what the dominant design would be, right? And I think that's some of what you see with like BlackBerry, like you were talking about, Andrew, is you don't know what will be the design that becomes dominant after that point. And then later on, cars are a lot more like each other, but earlier on, there's a lot more experimentation.
That's true, and GM was not afraid to strike out, and they're trying different things, and even in the early days, and you brought up the used car market, which is interesting. And Ford really kind of created the used car market. They didn't realize it, but the Model T not changing for so long, is what kind of pushed the used car market so much to come into an existence, because you had so much volume of one model of car. Eventually, once people were ready to buy the next car, they wanted something different. But so Ford kind of created their downfall in one small aspect, in terms of they helped create the used car market, but didn't realize the fact that was kind of being created.
So as you can see on the screen right now for people watching on YouTube, one thing I just wanted to give context to is net profits after deducting all expenses, $35.5 million. If you inflation adjust that today, that's a $717 million company. So I mean, that's still a pretty big dang business for an industry that was still basically in its infancy. I mean, that's a lot of volume going through there, a lot of profits.
Yeah, and I guess GM very quickly did merge a lot of the successful companies. Like I said, Buick and Oldsmobile were very popular cars in the early days, and then Cadillac had a very popular high-end model, the more expensive car people could buy. And then actually in this report, which we'll get to in a minute, they acquired Chevrolet in this year. So Billy Durant founded the company, but he got pushed out, took on a lot of debt, and his position got diluted a lot through all these acquisitions. So eventually he didn't really have control of the company, and he got pushed out. He helped start Chevrolet with the race car driver, Louis Chevrolet, because at the time there was no car, at least to my knowledge, no successful car that was going against the Model T at the low end. And so in some certain years, Ford couldn't even make enough cars to satisfy the demand for low-end cars. And so Chevrolet, they formed to help compete in the low end. Ford still completely dominated Chevrolet early on, but Chevrolet was still able to gain a little bit of market share just because capacity was needed. And so Chevrolet is a key piece to the General Motors story. And Billy Durant started this. They acquired it in this report we're going to talk about here. And that's how Billy Durant took control of GM again the second time.
How do you think this acquisition affected their market position?
Yeah,
I mean, pretty favorably, or?
Yeah, it was a key. Chevrolet was kind of the key piece of how they're able to take over Ford eventually. And it's interesting. DuPont, the DuPont company acquired close to 30% of stock of GM, which I really didn't know that story until studying this. But they mentioned how they were able to buy GM in the market at below an asset basis. I think they mean below book value. But yet they were issuing stock to make these acquisitions above book value, paying goodwill and stuff. So that's kind of how Billy Durant was able to get control of the company again. Using cheap stock to make acquisitions usually doesn't work out great for existing shareholders, but it helped new shareholders like Billy Durant coming back in, kind of take control is one thing. But yeah, Chevrolet, kind of their strategy of how they able, in the book that you mentioned, Alfred Sloan, My Years with General Motors, that was one I read when studying this time period. He talks about when Chevrolet started, he said something about no amount of capital short of the U.S. Treasury would be enough to compete with Ford in terms of volume, in terms of like their low cost position. And so Chevrolet, what they did was try to offer like a little bit more options to drivers but charge a little more. So basically they tried to go in between the low end and the medium end and find a little niche in between. And that's kind of how Chevrolet found their place.
Is there anything else that stood out to you about 1918?
Yeah.
For the company?
One interesting thing from maybe the DuPont angle, in Alfred Sloan's book, he talks about, or he shows some writings from the DuPont people and why they made the acquisition. So that's kind of interesting. One thing they mentioned was they were able to buy it on a better than asset basis. Two, the DuPont company had been around a long time. I'm pretty sure back to the early 1800s. And so they were a much more mature company. GM is new in a new industry. And so they thought they could take control, maybe institute better controls, maybe make it more professional and stuff. But they also secured for their business to be a supplier of GM. So kind of they had some downside protection there. And so, yeah, the DuPont investment kind of helped GM maybe in terms of being more of a professional organization. And it's interesting to think about that too. And maybe the last thing in the report, I was pretty bummed in these early days, there's no income statement given, which I would have loved to see over time, how to go further up the income statement, see how gross margins change and SG&A costs and stuff too. Just because in some years they have a lot of what they call non-recurring expenses, and it's really hard to see that fluctuation, and it's hard to decide for yourself really what's going on the income side of things. But you get net profit and some things like that. You get a full balance sheet, which is nice. But I wish the income statement, I wish more disclosure was given there.
What was so interesting about this time period, and just the more you study a bunch of different companies in history, is the capital cycles that happen, right? And what happened in the automobile industry. I mean, it's basically the same thing that you see today, right? There's this new technology, and then there's a bunch of money that chases it, and there's an oversupply of companies chasing those profits, more competition, and then these companies run into financial problems, and there's consolidation, and then you sort of get this new cycle that comes out of it. So I think you had said that there were something like 2,000 car companies started in the early 1900s. Basically that is the consensus from my own research too. I saw somebody say 1,800, I saw 2,000, but basically 2,000 cars. I'm kind of curious, like, were these pretty, I mean, like, I was trying to think about it. I'm like, okay, 2,000 companies trying to do this. That's a lot. Like, is that, a person in his garage that incorporates with $1,000 to try making something out of this? Is it, I just wonder, like, the scale of these failures, if they were, large or whatnot, because 2,000 companies failing obviously sounds like a lot, but I was just curious if any of you, maybe Geoff, have any sort of idea on like the scale of that, or if that was even something that was, meaningful, or is that more so just sort of a hot topic?
Well, I mean, I think Sloan talks about in the book that most
just produce like concept cut, whatever he may have called them, whether it's
specimens or I forget what term he used, but basically prototypes that they didn't go into regular production, right? I think the difference is if you had regular production from one year to the next. There's a few, like I knew someone whose dad reconstructed cars from the around this time period, actually around 1918 or something, and there's a lot of cars that didn't make it for many model years. So I mean, there'd be a car that people really liked or something, but it ran for 2 years, you know. To actually be in regular production for a while, I don't know that there were a lot of those. And all the ones we're talking about are that way. And we should also point out, I think, like when you're talking about Buick or Olds, I guess it was called at the time, it like when early on in their sales, it's like one car that they have. It's not that they're producing like a whole lineup of them.
Yeah. Yeah, that's true. And some of the acquisitions GM made, they talk about they bought a car company. In some cases, it's not like Cadillac. It's like you said, it's more research design, not any production, but maybe they built some prototypes and they acquired that too. So it takes a lot of capital to do a full production. So I assume a lot of companies were more the prototype stage, stuff like that. And I'm curious too on that topic though, on like you said, Andrew, the capital cycle. In some years, like I said, it's tough with not a full income statement to really get a picture. So I didn't talk about it too much in my podcast, but in the 1910s, 1920s, there's some years of a lot better return on equities than I would assume for a company like GM. And I'm sure Ford did too. I don't have too much financials from them as Henry Ford took them private at some point, but you know, they were able to finance production without and finance high growth without bringing in too much equity investors. So I'm curious, one, what your thoughts are on maybe like return on equities for those companies in the early years, and if there's anything to learn from like Tesla, BYD, some of the new companies today. There's so much supply, competitive difficulties, but is there anything to learn on like maybe return on capital of the ones who happen to be successful in the early days?
Yeah, I don't have anything too insightful to add, but I did do a return on equity number because I wanted to compare it to today, and I was surprised at how high it was. And I was wondering if that, you know, part of that was sort of the criticism that a lot of the industrials in this time frame get, like, you know, cheap labor and working people like crazy and not, you know, paying them a ton and stuff like that. Like from an expense standpoint and stuff like that. But no, I mean, I was surprised as well. Maybe Geoff has more insight on that, but the ROEs were I mean, more than like 10%. I mean, I think one of the years I got like 15 or 16 or 17%. So I was kind of shocked by that as well.
Yeah, I mean, there are years where it seems like you have return on sales is over 10% and you're probably having 1.5 turns or something. So they're probably like that. And that would really be without leverage doing that. Like we said, though, you know, if you're in a situation where like Tesla was early on in their history, or like you were talking about with Ford, where they weren't even able to meet the demand that they had, then you're going to have pretty good pricing, right? There's also a difference that obviously the numbers that we're seeing, they're not having to pay taxes on that. Later on, I think you talk about the war years, they pay taxes then. But that is a difference. I don't know how important that is because, you know, theoretically, if you have higher taxes on things, then you'd have less investment in the industry. As a result, people take into account that they're going to pay higher taxes. So it's not like you just have very high returns on capital usually if you don't have a lot of taxes, and then you have lower returns if you do have a lot of taxes. Usually people take that into account investing in the industry. But that obviously attracted some of it. But all these years too, it's still way, way lower the returns on equity that they could have versus how much growth they would need to be able to meet demand to keep their market share the next year. So these companies can't self-finance really, even if you had very high returns. Because I think, like let's say a few years before the period we're talking about here, let's say between like 1908 and 1918, I mean, the industry's going up 3 or 4 times in size in just a few years. You know, I didn't do calculations of the exact growth rates, but you would need returns on equity of 100% or something to be able to maintain your market share and not. Now I know that GM did not pay a dividend though, which is very unusual for that period, right? It wasn't until the DuPont investment that they actually just had a large dividend and everything. I think they talk about that. So that would have been very unusual. Usually companies early on in their history, unlike today, would start paying a dividend pretty early. You know, as soon as you had profits for a couple of years, you'd immediately be paying a dividend. You would not be like tech companies today or something where you could go 10 years and not pay a dividend and when you're making money.
So when you talk about like the growth and the speed of that growth and needing to tap outside financing, is there any industry today that reminds you a lot of this time frame? I mean, would you put electric vehicles in that style box, or is there anything that sort of reminds you of it?
I mean, I think, yeah, there's some similarities to electric.
I think that's possible, but
The difference, of course, is, and DuPont invested in this and held it for like 30 years, I think. They had to, because of an antitrust issue, right? They had to get rid of it because of the purchases you were talking about. Because Ben Graham wrote about it at one time in his memoirs, because he did an arbitrage thing to be long DuPont and short GM, because GM stock eventually got very popular, DuPont not so much, and so you could get DuPont for less than the value of their GM stake. But I think the big difference is, like, we're talking about large amounts of investment in an industry like, say, electric cars, or when we talk about streaming, let's say, or a lot of these, that comes from other corporations that already exist that are very big and have very big, very low costs of capital. Here we're talking about much more, like we were saying, with people in their garages coming up with ideas, thousands of companies. The DuPont thing and backing them is a big deal when it happens. But this, do you remember you talked about, Jacob, when this became the biggest industry in the United States? Do you remember when that was, roughly?
Yeah, I think I believe in the 1920 annual report they kind of start start that report by going through all the it's basically the biggest industry at that time.
Yeah, he goes over it right here. So the Roaring '20s, we could jump into it. The automobile industry is new in every sense. Records show that the first garage for the storage and repair of motor cars was opened in Boston, Massachusetts in the spring of 1899. In that year, the investment in the industry was $5.8 million with the production of 3,700 cars, while in 1919, the investment was estimated at $1.8 billion. So that's gone up. And then you could see right here in this annual report, they break down other industries: petroleum, 775 million, pig iron, 809 million, cotton, $1 billion, wheat, 1.1 billion, coal was 1.9 ish, and men and women's clothing was about 2 billion. So yeah, it became a very big industry very quickly.
Billions of dollars of investment in the early 1900s is pretty high investment, inflation adjusted.
Yeah, I did. It was like 315 billion or something like that. I mean, that's huge.
Yeah.
Huge. So 1920s, the Roaring '20s. What was something that, originally stood out to you in 1920, and then we could, talk about this annual report?
Yeah. Yeah, they do. DuPont takes over, and they do start paying a dividend kind of throughout the 20s and into the Great Depression. It's a little bit funny to me when you're paying a dividend, but also issuing stock to raise money. So you need to raise capital, but yet you're paying a dividend. I guess it maybe reminds me today of companies that, maybe buy back stock, but issue a ton of stock through stock options and stuff like that too. You're kind of doing one step forward, one step back in a way. But yeah, it's a high capital investment in the industry, and yet the management talks about how a lot of people, at least maybe in the media or citizens and stuff, some people are unconvinced of the car lasting. Some people say it's a good economic time period post-war. It's a luxury vehicle. It's fun. People are just blowing money on it, but it's not really going to be a serious industry long term. Some people had that view. And so you are spending a lot of money, a lot of CapEx on something that for some people was still a big question mark if it would change American life day to day over the long term, which is one interesting aspect in the 20s. And then this report in particular was interesting to me too, because so much growth. Some years, sales doubles for the industry or whatever in a single year, but then every once in a while they take like a step back or economic downturn where all of a sudden sales come to a halt when companies are not expecting that. And so this is one instance where by late 1920, GM had a serious inventory problem, which was kind of interesting to take a look at.
Geoff, can you set the stage for what life would have been like from an economic standpoint in the 1920s?
So we think about that comes later in the period, and particularly the stock market bubble around from like 26 to 29. But it's similar to the 1990s that way. That doesn't get started till later. And this is a very, very severe, though short, depression. They would call it a depression back then. We call it a recession now, but very sharp. That happens in 1920, 1921. It's close to only something like what happened in the 70s, or maybe what happened when Volcker raised rates a lot. Very briefly in the 80s. But again, very sharp recession. You have deflation coming out of the war because you'd had inflation during the war. And so this was like really brutal change in the speed of the economy from growing to contracting really rapidly. And of course, you had a pandemic and everything a few years before, the same as today. But you have this mix from going from wartime to peace. And what would happen then, had happened every time in American history when this happened, is that you went into deflation when you went into peacetime. And this was a really severe but short depression that is not talked about that much today. And so that's part of it coming in the roaring 20s, like in the 1990s, with a recession really early in the period. It's also that you're coming out of that. So like when we talk about stocks and everything, they were really cheap at the bottom of this period, and then the earnings really recover quickly from that. But Jacob, do you want to talk about like the inventory situation that we're with this? Because that was a big part of like when they talk about this period economically, people talk a lot about inventory liquidation, that the country was liquidating, having had too much in inventory. That was kind of the cause of this recession.
Yeah, and GM had to do that. And you mentioned how sharp this downturn was, and I'm sure the Great Depression was bad, and at times it was sharp. But I think the reason it stands out to people is because it was so long. At least some people list it from 1929 to 1939, like 10 tough years. The length of time stands out to everybody, versus there maybe were worse periods or tougher, very short-term periods that they just happen to recover quickly from, which maybe it leaves people's minds. Like I've never really thought of 1920 as any particularly bad year or anything to me. They did have deflation. So that was inventory, as well as some of the price commitments they entered into before maybe realizing there was going to be deflation. Both of those impacted this period. So management at least, writes about how after they get into some issues, management writes about how they set budgets and set limits to their divisions, told them maybe to slow down or not exceed 150 million in inventory. These divisions blow past it. So either lack of controls, tougher communication, maybe slower communication back then. GM was very decentralized, and so some of these divisions operated as if they were separate companies. Maybe Cadillac feeling like they're a separate company than Chevrolet or whatever. So management set an inventory limit of 150 million. It ends up being $210 million, $60 million over. There was a sharp decrease in revenue, and yet they still were keeping up production at high rates and entering into future like purchase commitments for supplies and stuff, as if there was no revenue downturn, or maybe as if they thought revenue would bounce back. They sell it through retail channels, obviously, like dealerships, and so maybe there was a lack of communication there in terms of the dealers might have been buying inventory or buying cars at a similar rate. Maybe it was a slower reaction in terms of dealers as well, like the end consumer. How sales were doing between the dealer and the end consumer. So that's something that management talks about they got better at later on as well. But $210 million of inventory, that was a major portion of the balance sheet, very high. And they had a big cash crunch, so they had to finance that inventory with short-term debt of $83 million. And so short-term debt on inventory that you're struggling to sell, and purchase commitments that look like high prices now because of deflation. They had some real financial difficulty in this period. They're very slow to react. It kind of reminded me of the Geico period we just talked about. Geico was maybe a little slow to react to inflation, slow to raise their prices. You could have a great history, but if you don't execute in these tough businesses like insurance and the car industry, you can really run into some problems. And so it shows GM and Geico are both in industries where you really had to execute every day. And GM ran into an issue here where they kind of failed to execute, and it it did kind of threaten the company a little bit in this period in terms of how much debt they had to take on. And if the Great Depression, if this lasted 10 years like the Great Depression did, GM I'm sure would have went bankrupt. But it was such a quick downturn that they were actually able to liquidate inventory, like you mentioned, Geoff, serious liquidation, and then they were able to recover.
I was thinking the same thing when I read through this. I mean, Geoff, do you think that it was lack of internal controls or communication that caused this big discrepancy? I mean, when I was reading through it, I actually appreciated how blunt he was about, this is what happened. And this is because sometimes I feel like public companies may just kind of come up with a lame excuse, but he was basically like, hey, this was the budget that we set and we basically blew right past that and didn't manage it correctly. And not only that, but I think he also said that like those individuals are no longer with the company. But I'm curious, Geoff, I mean, what do you think caused that? Was it just the product at the time without having email and Excel and being able to track everything down to the penny like you can today?
I mean, I talked a little bit of this about the podcast, but I went to a Walmart coming out of COVID happening that was horribly overstocked to the point it couldn't take any more deliveries. Trucks were sitting out in the parking lot. Things were, had to be piled up in the aisles and everything. And it's just an issue of, these orders happened during a period of a lot of expansion, and when they thought things were suddenly growing a lot, to contraction. Now, in the case of like Walmart and Amazon and some of those, it may be more understandable because a company like that expects units might grow by a couple percent. Like, let's say your supermarket, you expect a couple percent. A year would be a good year for you if it changes by that much, and suddenly it's changing 20% or something because of COVID. So it's unprecedented and you don't understand what's happening. But this was still a very fast-growing industry. So it would make sense that they were growing really fast and they didn't know what would happen in a recession, that it could change so quickly that way, right? And as you talked about with the retail channels, right, that may not have been all that well developed. There were a lot of them, right? There were just huge numbers of them, and probably many of them weren't selling all that many. They were new. There probably weren't actually that many retail outlets that had been around for very long. And so all of this is stuff that people may not have had a lot of experience with. Atari in video games, right, had a year where they had massive losses because of inventory problems. It was a new industry. People didn't really know how bad it could be if you thought you were going to have a hit and you didn't. And people may not have known how discretionary it was in terms of that there'll be years where people will put off for a year, right? I mean, even though there was no lack of demand in the long term for cars, there's no reason why people had to buy it that year, that you would buy it in a year in which it was bad economically. So you can certainly put it off for a couple of years.
I do remember you talking about on the podcast, the Walmart that you were in. I think you had said it was horrifying to you. And then it seemed like, 4, 5, 6 months later, we started seeing all these articles in the Wall Street Journal about them basically not wanting the inventory back. We'll pay you for it if you want to return it, but we actually don't want it because we don't have anywhere for this. And all these companies like Target and Walmart, they were going through their inventory problems.
I was just going to say, do you think part of it's they're scared of, if they guess wrong and competition gets more sales than them because they just weren't ready to have inventory stocked? Do you think it's kind of scared of losing sales to the competitors in that aspect?
Yeah, I mean, most retail things know that the easiest way to lose sales is not to have it in stock, right? That's the really big problem. That's the problem for, like, when we talk, you could talk about Tesla or something. Could they have too much inventory at times or whatever? But they know that the problem is that if you say electric cars, right? If you don't have something that's that new and that popular, it's very easy for it to be that something else will sell. Game consoles or something, right? If you're both coming out within a year of each other, you're at risk if you don't have your Xbox out at the same time that Sony has their PlayStation out or something. Otherwise, you won't lose the sale. If you're available and people prefer you for whatever reason, then you're going to get that sale. But the easiest way is to not have it in stock, right? And, you talked about with the Model T and everything, that they weren't able to meet demand sometimes. That means that it spilled over into other people making money, right? Because they, in essence, grew the industry, got people comfortable with it, and then that creates a situation where you might be interested in other sorts of cars. And, that happens with any of these. But it certainly happens with a retail thing, right? Mm-hmm. That if you don't have the inventory, then someone else is going to be able to make the sale. But the problem is if you see a fast increase. And this is also a big deal because of like we talked about the inflation and then the deflation happening that way. But that happens even now, because I mean, I remember looking at Tesla after during COVID time, right? And people were talking about how they had an improvement in their profit and everything. And when I looked at it, there was a period of probably about 6 months or so where I don't think on a real basis they actually made money as a car company. It was all from holding the stock for that period. That inflation was so high that the entire profit margin, you could have 20%, 25% returns on your sales just because you held something. And so you went from a period of inflation to a period of deflation. It might have been something they really weren't used to. And the other thing is, it had been a very long time since they'd had major inflation and deflation in the country. Just like now, it was something that wasn't that familiar to them. It probably was, the last time there was a recession that bad was probably 50 years before, I think, in the 1870s was probably the last time there was one as sharp, as bad as what happened there. So, people no one would have had firsthand experience.
I always wonder, like, is that even the right answer, though, to a lot of these things? I mean, even today you're hearing about Amazon and how they overbuilt like their warehouses, and they're, started to basically offload that and get that off their books and whatnot. I mean, to your point, Geoff, I mean, Amazon they would rather die than not having inventory on, their website or whatever, or for whatever reason, somebody having to go to Walmart or Jet.com or Walmart.com or wherever else people shop than going to Amazon. I mean, they probably knew, I imagine, that they were going to like overbuild and then run into issues maybe, but that was better than the alternative of not being able to fulfill whatever that customer wanted.
Yeah. And it turns around quickly what happens. I mean, I think the lag is a big part of it, that you committed to these things and then you agree to take them, because one factor, like when we talk about inflation stuff, is if they can get data on how much over ordering there is, that's a really good indicator of whether there's going to be inflation in the industry. So but it's very hard to gather that as like a government or anything like that. But if you find out that really Dollar General, Walmart, whoever is saying, oh, I'll order 5 boxes. I really only want 3, but I don't think you'll get me my order. So I'm going to over order so that you fill part of it so that I get the amount that I actually need. Because at some point, they'll eventually fill those orders. So the unfilled orders part of it. And sometimes that's a really big part of it, when suddenly all the orders get filled coming out of it, when the demand drops off, and suddenly you're able to meet demand. Jacob, do you want to talk a little bit about how cars were sold at this time? Like how many dealers there might have been out there, how many they were selling, how new it was, any of those sorts of things?
Yeah, like you kind of mentioned, the sales channels were less developed, so there were dealerships. But Alfred Sloan, who takes over for Billy Durant, and he wrote that book we referenced a few times, one thing he was able to do or kind of champion later on is help develop the dealership model in terms of, GM, I guess, didn't like own dealerships, and you could look at it as one of their customers, but at the same time, like helping get more organized in your communication with dealers and help get more organized in terms of standards, in terms of accounting. One thing they had was, a GM accounting subsidiary, an audit or something that would like work with the dealership organizations. And so that's one way they were able to develop like the dealership business. The number, I don't know the exact number of dealerships. It was huge, but in the annual report, they talk about the number, but they mix in like the number of dealerships, like mechanic shops, gas stations. I think they call them charging stations, which for a second I was like, I knew electric cars were a thing in the very, very early days, but I think they called gas stations like charging stations. So that number's, the number they give is huge. Is it 178,000 it says there? Which I imagine can't be just dealerships. That's a huge number, but
charging stations, garages, and repair shops. Yeah.
But based on that, we can kind of imagine, was it possible? I mean, I don't know enough about the history about the really small scale stuff, but was it possible that some of those shops were thinking, oh, I'll buy a couple cars and I could sell 2 cars a year or something, that these things that are involved in other parts of the business of, like we're saying, that we would think only of service stations and things at the time, thought, hey, this is a really fast growing business. Maybe I can be an outlet for that. We think really strictly about a difference between the place that's going to sell you your car and things that are going to work on it and do other things. But at the time, it might not have been clear that if you were in the business providing gasoline, that you're in the business providing service, which probably was a pretty important business at the time. There were a lot less reliable cars, and there was a lot of differences between them, right? That maybe you'd also be involved in other parts of it, you know? They may not have known that it'd be such a consolidated industry that way.
Yeah, and it's just a good way to think about in the early industry. It's very hard to tell how it's going to develop in terms of how the car is made. Yeah, the retail channels. It's just there's so much more, so much unclear back in this time period.
So do you want to talk about also the acquisition of Fisher Body Corporation and how that affected the situation of General Motors?
Yeah, I'd be curious to hear what you guys think, because in my opinion, this is a big part of the story too. And it just made me think of, Jeff Bezos. I heard a interview a long time ago that this reminded me of. He said AWS had very little like-minded competition for 8 years. And he said he didn't know of any story like that, of having that big of a lag. Businesses, it's usually, he brought up all the different businesses like Amazon.com, BarnesandNoble.com launched 2 years later. And he brought up a few different things where it's always like 2 years someone jumps. GM in the 1919 annual report, they talk about, they acquire Fisher Body, which mostly, it was the biggest in terms of closed-bodied cars, which open body versus closed body. I think of it kind of like a convertible versus not, but I guess back then all cars kind of had an open body. And I think if you look at pictures, some kind of looked closed, but I think it's more of like a very loose cover on top of some of these was kind of like what an open body might look like. So GM talks about the rise of closed bodies in 1919 annual report. And Ford, the Model T was an open body design. And so Ford closed their plant in 1927 to remodel and kind of shut down production of the Model T. And so really from 1919, when GM makes this acquisition, all the way till 1927, 8 years, Ford really wasn't doing much with closed bodies. They did put a closed body car on the Model T, like a closed body on the Model T. Alfred Sloan talks about it wasn't really how the engineering design should have been for the Model T. So I guess they put a closed body on something that wasn't really supposed to have it, I guess, or something. So Ford was very slow to adjust to the closed body design. And it shows GM was diverse. Like I said, their philosophy was variety and diversity in terms of how engineering and designs could change over time. The closed body was one example where they talk about it in 1919. Ford doesn't really do anything about it until 1927. In 1919, I believe in that report, they talk about forming GMAC internally too, which is interesting. We could talk, GMAC would be an interesting thing to talk about too. Henry Ford himself didn't really believe in financing cars, I guess. He wasn't really against that kind of consumer debt. And so Ford really didn't have a comparable financing program in the same way GMAC did until maybe even 1928 or 29 or something. So that's another example where they're like 9 years behind GMAC. So just back to that Jeff Bezos quote where it's unheard of to have an 8-year head start. There's a couple examples where GM had a 8 or 9 year head start in a few different areas.
Why do you think Ford was so slow to adopt this new method of a closed door car, right? So one thing that I thought was interesting in these reports reading, like General Motors, they seem so focused on the customer and like what the customer wanted. And then Ford was very slow to change. This is our way. We're not going to do this. We're not like those other guys. Why do you think that is?
When I picture Henry Ford and I think about his personality just from some of these biographies and stuff, I picture a very old school mindset where it's like people shouldn't take out debt. So I'm not going to, we're not going to have a financing program. These people shouldn't be going into debt. That's not good. Or we want the lowest, in a very, very strict focus on the lowest cost. So I just picture someone saying like, a new color's frivolous. We don't need that. He doesn't care what people are demanding. He's like, we don't need that. We're going to do the lowest cost car possible. I know what's best. That's kind of like what I picture when I think of his mentality. And I think his focus, so many founders have like such a focus to get to execute. So he did a great job executing in the early days to get his top position. And one way was keeping the cost low, because a lot of consumers weren't buying cars in the very early days. So him focusing and getting the cost as low as possible and not offering as many things, maybe helped develop the car industry and maybe benefited GM and other companies and stuff too. And so in one way, his focus and stubbornness benefited the industry and Ford early on, but eventually was his downfall.
What are your thoughts on the GMAC program and just different innovations that were brought to, the market during this time, right? Such as you said, like installment sales, I imagine was very good for GM and part of the recipe for their success.
Mm-hmm. Yeah, I would love to hear your thoughts on this too, but GMAC bankers at the time thought it would be very unsafe to loan against the automobile. Consumer financing was not prevalent, and it was thought of, like I said, as a luxury and for sport. And so maybe risk takers or people wasting their money or something. So, bankers did not want to loan those kind of people money against a toy or something. Is kind of how people thought of it. So as the industry developed, it became a very big industry, and there was no financing for the end consumer and for dealers themselves. And so that's kind of how GMAC was formed. I don't think it was any big master plan of we're going to have this big profit center or whatever. It's they saw a gap in the market, and they were able to. I think first the main focus was finance dealer inventory. At least the way they talk about it, GMAC was to finance dealer inventory, and then it also adds, and almost at the end of the sentence they talk about and consumers as well. But I think dealers were the number one start to it, and then they finance for consumers too. And it proved through this period in 1920 and in the Great Depression. Generally, loan losses were low. People were paying their loans, so it turned out to be a good asset to lend against. But at the time, there was a gap in the market, and people weren't doing that. And I guess it kind of makes sense a little bit from a distribution perspective of GM. Had maybe they had the distribution set up to sell these loans to their dealer network and to the end consumer. And if they had to repossess a car, they had a retail network to kind of resell that. Maybe they could fix it up if they needed to a little bit because they were the expert on the cars. And so it kind of makes sense there. And so I'd be curious to hear your thoughts, one, on that, and two, just thinking about that, I always wondered why maybe car insurance never really took off, at least as far as I know, in terms of the car maker themselves in the same way that auto loans did. And the only thing I could come up with here is that there was no real gap in the market the same way that auto loans was. And then maybe the second thing is car insurance, you have like medical costs, and you have to understand the driver themselves, not just the car. Maybe that's the things I could come up with of maybe why car insurance companies were able to differentiate themselves and kind of not go through the car makers. But what do you guys think about that?
Yeah, that's something that's always interesting that, in this early period at least, and for a very long time, you had the car makers themselves involved in all of this financing to help sell the stuff, which isn't unusual now to think about that, whether we're talking about appliances, mattresses, whatever. It's a huge part of how the product is sold, and without it, it wouldn't happen. It is interesting, and I wonder what GM would have done if they probably just experiment with it, and if they had large losses early on, GMAC just wouldn't have continued. They shut down plenty of things, so it's probably just something if you're not betting the whole company on it. It turned out, like you said, that the loan losses were very low compared to what people expected, and it wasn't something that banks were willing to get into and everything. So it worked out well for them. It is also interesting why there wasn't why people weren't rushing in to lend against this early on, because it was such a fast growing industry, but it's also interesting that there weren't all these big companies that were putting up capital to finance the car makers early on, that they were undercapitalized and everything. So it's just a big difference between today and how these things work and versus what it was like then.
And that could lead into, we could talk about the 1932 annual report and the Great Depression period, because GMAC, it says business kind of slowed down a little bit for GMAC in that period, but it still said they had a substantial profit in the early Great Depression in 1932. GMAC themselves had a substantial profit, maybe not GM, the overall company. And then even in the height of the Great Depression, it said loan losses were below 1%. I think they basically mean 1% of the total value of the loans. And so loan losses were low, GMAC was profitable, and the Great Depression, I guess, is a great way to test that business model there. But yeah, as we get into this 1932 annual report, Andrew, you mentioned you felt like the management was pretty blunt, and they are in this report too. And I wonder if that's one reason why Buffett maybe liked the report. I think he likes. It seems like he likes that. Maybe Jack Byrne and Geico kind of more bluntness. Some of Buffett's reports, he's a little more blunt in some cases. And then, I don't know, maybe that's why he enjoyed this report.
Mm-hmm. Yeah, so to set the stage for people listening, net earnings from operations for the year 1932 after full depreciation charges were $165,000. Okay. This compares with earnings of $115 million from operations for the year 1931. So I guess barely profitable. And that's a huge jump in 1 year, jump in the direction that you do not want to go. So what happened in 1932, Jacob?
Yeah. So they were profitable all through this first part of the Great Depression, even though, in this year, $115,000 is basically nothing. But they were still positive. And so maybe the Great Depression to start, 1929 started out as a big jump in sales, the start of the year. I think management talks about the stock market was up big at the start of the year. And then both the economy, car sales, and the stock market all kind of crashes towards the tail end of the year. So I think 1929 itself, in terms of sales, I think was pretty flat or single digit growth or whatever. But that doesn't really tell the story of throughout the year, a big jump. And all of a sudden, sales kind of drop off. From 1929 to 1932, revenue was down 70% at GM, and really throughout the industry, unit sales revenue for all companies, for the whole industry, was down over 70% as well, maybe closer to 80%. So a major jump down. And so when I first see that, it's like I saw how difficult the 1920 period is. In a single year, they had about the same decrease in sales, and then for a 3-year period, far bigger decrease in sales. And so you'd think if the same organization, if they were operating the same way as 1920 in this 1932 period, they would have experienced some major problems. And maybe I could carry on to there with just back to inventory. In 1932, they end with $75 million of inventory. I mentioned in 1920, it was $210 million they reached. But that's 12 years later. This was a much larger organization 12 years later. Maybe sales in this 1 year wasn't, any bigger, but in 1929 they had 1.5 billion of sales, triple maybe the earlier period. So a far larger organization in terms of employees, in terms of what they're used to in sales, maybe what they plan for in terms of unit volume. Far larger organization, but yet they were able to halt production, have inventory control, and have 75 million of inventory at the end of 1932 versus 210 million for such a large organization.
So 3 years into an industrial depression, I mean, I'm just curious. I mean, did they make any other changes to like their manufacturing process during this time to really adapt? I mean, we are reading this now on a screen, but imagine being like, during this time frame, you're 3 years into it, and your sales go from over 100 million to basically nothing. Did they change anything during this time to really adapt through this time period?
Yeah, the thing that stood out to me right away was 1929 through 32 annual reports. They talk about kind of shrinking the business, at least in terms of production. And so I'm sure operating costs, they laid off some employees and they were tight with their operating costs, but they did not skimp on R&D or technological improvements. They still kept spending money on R&D. They talk about how they're investing for the future in that aspect. And so they let cash pile up through the 1920s a little bit. They still made some acquisitions. They bought, even everything from an airplane maker to airplane parts, radio makers, other car companies and car suppliers and stuff through the 20s. But each year they added a little more cash, even though they're paying a dividend. They still, cash kind of piled up on the balance sheet through the 20s. So they were in a good position when the Great Depression hit. Maybe slightly luck, but also just from pretty safe conservative operations, letting cash pile up. Then they were very quick to cut production. But they're financially, since they had so much cash and since they prepared and executed so well, they were able to still spend money on R&D and improve the product. And so not only they're like debt free and had a lot of cash, so it looked like, pretty safe bet they were going to survive. Maybe their competition sometimes didn't know, weren't as sure they'd survive, number one. And number two, GM was in a good position to keep investing in R&D and technological improvements where their competition maybe was not. So that was the main thing that stood out. And they still paid dividends in this period. So dividends exceeded net income 1929 to 32, which I know there was very little income in 32, but still talking in the hundreds of millions the couple years before. They still paid out some nice dividends to shareholders in this period.
You have up on the screen there the net working capital position, or you had it up a second ago.
Yeah. Right.
So as Jake was talking about, so obviously very liquid and would have seemed very safe at the time, except for the fact that it was losing lots of money. But you assume at some point that comes back, or you wouldn't be investing in a car company at all. If you didn't think, if you thought it was going to stay down 70, 80% from where it was before and never come back up, then you're making a bet that the industry's, there's never going to be the adoption of the car as widely as people originally expected, right? If you just think that eventually this is a depression that will end, then this is a company that looks a lot safer than the one that we saw in 1920, right?
Given how tough the car business is and given how hard this time period was, why do you think Munger and Li Lu are so comfortable investing in BYD? I mean, ultimately Buffett, even though Geoff had said he thought Buffett was probably dragging his feet on that and Munger really pushed him for it. Like, given that they know that this is probably the same playbook this was a very challenging time where you had so much investment going in, so much competition. Like, how do you think they got comfortable with a company like BYD when they know that, this happened?
Yeah, I was going to say, I was trying to remember who Munger compared the founder of BYD to. Was it Henry Ford and Thomas Edison? It was two people. One of them was Henry Ford, I'm sure. So it made a point that it was a big bet on a single person. But it is interesting when we're talking about Ford, the period that didn't go so well for them. Obviously, they had an early period where they had huge dominance and got, in a period of a decade from coming out with their first model, they had most of the market, right? And the market had grown tremendously. You did very well with that. And but who the leader was, like we talked about, changed, right? That's a question for you, Jacob. But yes, I did say I think that's definitely much more Munger than Buffett. Buffett did it because Munger wanted it, I think.
Yeah, it's something I've spent time thinking about. I don't know if I really have a good answer. I know, and I swear in an interview Li Lu has done, he's talked about studying the early GM history. Munger has talked about multiple times studying the early GM history. Maybe that was a slight inspiration for the book I wrote, Capital Allocation. I remember in one of the annual meetings, Munger talked about how business school should go through year by year in like a value line type way, but explaining the numbers, a company like GM and different companies like that. And that's kind of like, I guess, the way I tried to write the book I did on Berkshire. And then when I take a look at these podcasts, I guess that's kind of how I'm trying to think of it for when I study GM here. I don't know if I have a good answer. I know that's one thing that piqued my interest when even the return on equity we already talked about, but in some years I saw it even went over 20%. And so just comparing that to the present day, I didn't know if that's one thing they saw of some of the companies that rise to the top in the early days, if it's kind of a better business than others. But I don't really know. There's so much supply, so much competition, especially in China. There's a ton of electric car companies that seem to be getting adoption. And maybe just the one thing I could think of, again, not a great answer, but BYD themselves was started outside of the car business. And I know I've read Munger and Li Lu talked about, they tried to talk BYD out of entering the car business in the first place. So they liked the founder and they liked maybe the business and stuff even before they entered the car business. But I know it's a company that was able to kind of like spawn off into different industries, different businesses, and have some success. So I don't know if that's where they were coming from with that investment too. But it's something I think about a lot. I don't know if I have a good answer, but it's a pretty interesting thing to study.
Mm-hmm. So Geoff had hit on, the net working capital position was good. Jacob, you talked about they were still paying a dividend, which is good. Do you have any idea of like how Ford was weathering the Great Depression? I mean, obviously GM was doing okay through it as best as they possibly could. What did it look like for Ford?
Yeah, I do know they shut down production completely for, I believe, close to a year in 1927 to remodel the Model T. By that time, really, I think stop the Model T and put new models into production. It was a private company at that point, and I don't think they went public again until the 50s. Basically, Henry Ford was able to take back control when they were in the early 20s and late teens or whatever, when they were dominant. In 1927, basically Ford had zero sales. Private company, they were able to just stop. So they had a lot of sales after that. Once they started back up production, maybe some of that sales they missed kind of got pushed forward into other years, like leading into like 1928, 29, maybe even a little bit 1930. I think in Alfred Sloan's book, he says by the time they shut down production in 1927, Ford was forever kind of lost their position for good, even though he mentioned in like 1929, 30, and I think 32, Ford regained the top spot for those few years. Basically, Alfred Sloan was saying that was just a very temporary phenomenon. 1928 and 1929 could have just been because they lost some sales when they shut down and that got pushed into a new year. 1932 could have been when you're at the height of the Great Depression. People might have reverted back to that cheapest Model T type mindset, basic transportation kind of thing. I don't know exactly. So to answer your question, it was a private company, so I don't have a great understanding of it, but I know in 1932 and some of the years leading up to that, they regained their spot on top. But after 1932, I think from that point on, GM was the leader for decades to come.
And for people listening, so total number of cars and trucks sold in 1932 was 1.4 million. To add context to that, in 1921, it was 1.7 million cars sold. So, that was down a lot. And the height was 1929, which was 5.6 million. So it was back to, in 1932, the annual report we're referencing, it was basically back to below 1921 and down from 1929 of 5.6 million. And estimated retail sales value in 1932 was about $1 billion, which was down from a peak in 1929 of 4.7 billion. So you talk about, just a full-on stop in the industry.
Yeah, major change there.
Geoff, was there anything else to you that stood out? Why do you think Buffett says 1932 is one of the best annual reports he's ever read? Given he's read probably about 1 million in his own life, I'm curious, do you think that was just how blunt they were about everything and just truthful about all of it? Why do you think he thinks that?
Well, I think also there's a part you talk about on the podcast, Jacob, where you say, that they basically, that in 1932, they recognize in the annual letter, I guess, that they are a few years into a depression. That, it's not, I think part of it, the interest for Buffett is probably that this is like a historical document, right? He's talked about liking to read newspapers from the time, not just reading some textbook about it later. Of course, we can say, well, it'll be however many years more. But like you had there, the production numbers, the sales numbers, Andrew, with the stock market, this is a big part of it, is that I've talked about from 29 to 32 and everything. A lot of people, Ben Graham, some others, had some of their worst part a couple years after the crash. It wasn't when the crash happened. They then bought things thinking it was cheap, thinking that this was a great opportunity. And a lot of people bought using debt, as many people did in the stock market throughout the 20s. They did thinking that they had really good values. And things went down even further. You could see, imagine you're a value investor, to bring it back to that, because it's an investing podcast. If you see
You have a decline of
30, 40% in 1 year period, and then you have a decline from there, probably 2 years in, you're thinking this is not a bad time to buy, you're not thinking it's going to go back to the levels that the industry, which is a very fast growing industry, would be of more than a decade before. When you're down 50%, you don't think that you're going to go down another more than 50%, right, from that level, but you would. And some people did it, on margin or did it, or, invest in companies that wouldn't make it through. So I think living through the period, it's helpful that way. And also, if you see there, you gave the retail value too. It's helpful for people to look at that, the price levels in 32 versus in 21, how bad that is on a per unit basis too, to keep that in mind. Because you both have really weak quantities sold and you have really poor price, right? Mm-hmm. And you could just imagine how in 30, 31, 32, imagine early in 32, value investors are probably thinking this is a great time to buy these kinds of things, and you wouldn't immediately pay off for you. So I think being like right in the middle of a contemporary document is one of the things that he likes a lot that way. What stood out to you about that historically about the 32 report?
For me, it's how they were able to recognize and tell shareholders the tough position they were in, one, and two, what they're going to do about it, yet still not say that the future was rosy, but say like what they were doing about investing into the future in terms of R&D and focusing on surviving now, but making sure their position was improved maybe in the years to come. But I think what you said about the historical document is spot on, and also what you said reminds me of Geico. Their first one bad year, when I was reading that report, kind of piqued my interest. Of the stock was down 75% or whatever it was, and one bad year. Yeah, sometimes someone like me gets excited, and you think you see value, and then in this case, the Great Depression, if you one bad year, you still got 9 to go or whatever. You have a long time before recovering, which is a very good thing to keep in mind if anyone's going to use margin or use debt or whatever. When you're thinking about your own personal financial position, it could take a long time for some of these periods to recover. And so it is interesting. And like I said in the podcast, I was always curious how much the Great Depression was after the fact. You look at it and call it that, or during the period, how much you feel that. So in this case, it's interesting to see them talk about being 3 years into the Depression, and how serious they take it and stuff like that. I'd be curious how many other companies took that position.
Were there any other just sort of big takeaways from studying these annual reports that you'll take with you as you look at other companies? Or I have a few that I could go over, but Jacob, maybe we could start with you and just any general big takeaways.
Yeah, number one, I tried to highlight everything I could think of the difficulties of the car business. I'm curious if you guys have any more to add. Maybe another thing was thinking about execution in business. But the difficulties, obviously, there's high demand, which is great, but high supply in terms of new entrants. The successful founders, they might not have sold that many cars, but today Buick, Oldsmobile, GM, they still are around and sell a lot of cars. But David Buick lost control very quick. I think his name was Ransom Eli Olds for Oldsmobile. He lost control almost immediately. Billy Durant lost control twice of GM. When you look at certain media businesses or something like, your next 5 generations of your family is going to be rich if you hold on to, the dominant, the Wall Street Journal or the Boston newspaper that's popular there, the Washington Post or whatever. Just what surprised me was seeing the successful founders very quickly lost control for these companies, besides Henry Ford. Product innovation means the CapEx you spend might be worthless or obsolete. The inventory you build up might be obsolete pretty quick, which is risky. The high capital needs is why those founders lost control. They all got their positions diluted pretty quick. Product innovation means that you don't really have a moat, because Ford, if you're not executing, if the product or consumer demands change, if you don't execute, that innovations could make you lose your top spot. And then the last one, labor intensive, just unions. They might negotiate higher and higher percentage of your profits over the years. Those are the things I came up with. I don't know if you have any others, but it was just interesting to me thinking about how very few founders besides the Ford family lasted with these companies.
Yeah, one thing I thought was sort of add on to your point of like execution, right? GM was very aware that this was a very like rapidly changing industry. They talk a lot about like the customer and stuff like that. It was an early industry that was growing like crazy. And as I had said, I felt like they were sort of studying their customer and kind of catering to them. That was on one side. And then Ford, they were super slow to pivot, right? Like it took them something like 8 years to, adapt and the customers, that's probably a huge reason why they lost some market share to GM, especially because they had 60% market share. I mean, that's pretty incredible. But you see that a lot even today. I mean, most companies, what's the word that they use, right? Like finding product market fit, like you're iterating to, what the market is. And I think Ford, didn't do that, where GM on the other end would kind of perfectly understood what they were doing, that this was a rapidly growing industry, that, the customer could be, want certain things and whatnot, and that they should cater to them. So I think they really managed that good, where Ford, on the other hand, didn't. And that's probably a huge reason why they ran into, market share issues and stuff like that. And also just the takeaway is, just again, when you are looking at these industries and the cycles that these industries go through and how things can change over time, right? Like railroads at one point were horrible businesses and there were a bunch of them. And now railroads are considered to be a pretty good business and a great industry with high barriers to entry. Where, like the Wall Street Journal, for example, used to be probably a pretty good business. And now, things have changed. So really just understanding that the change that can happen over time. And when you read these old case studies or you read these old companies, whatever, just being able to basically see that in real time as it went through the years. So that was a big takeaway for me.
I was going to ask you, Geoff. So my takeaway too, execution is so important in business. Geico, slow to raise prices during inflation. GM, slow to respond when they built up inventory in 1920. Ford, slow to respond to some changes in the market. It just hammered home to me, execution. It's like a daily battle in business. Is this a lesson for all businesses? Is this industry dependent? How do you think about that?
Yeah, I mean, I think it's somewhat industry dependent, or at least like what phase in the industry, like we were talking about. This was a fast-growing, capital-intensive industry. I think it's really interesting also if we look at it from a company perspective versus from like an investor individual perspective, right? I think Alfred Sloan, who had one of the biggest fortunes from this, ended up with like 1% of the company or something, I think, when he said he's one of the largest shareholders, when he's writing his book. So whereas Ford made money, Ford family made money, there's actually not a ton of huge family fortunes that have come out. There's a few around the world, but there's not a ton of huge family fortunes that have come out of cars. Whereas let's think about like, Ballmer or something at Microsoft, right? Not even one of the first employees really, and one of the richest people in the world. So there's some businesses where it's a bit easier than others. DuPont, right, was able to buy about a quarter of the company, on terms that, probably meant like what capital had already been put into it. And that was at a phase where it's one of the leaders in the industry at that point, So you could wait. I mean, DuPont kind of got to wait a decade and see how the car industry shook out and whether they'd be one of the leaders, and still could get in on terms that weren't different from, if you were putting in money as a founder. So I think that is really interesting from an investment perspective. It's hard to imagine when we talk about tech things, the soft tech things, that 10 years after Google really gets started, Microsoft really gets started, you're ever going to be offered the opportunity to get in on the same sort of terms that the founders did. But here in the car industry, that happened time and again because these founders, they got stock in the bigger entity. And they got to, we didn't talk that much about it, but sometimes it was the founder who was running the division basically for a while, and everything sort of like what can happen at Berkshire and everything. So they had a long career as an executive, made plenty of money, but they didn't get rich in the same way that founders get rich in a lot of other industries from this. You can really see the costs of how much capital was needed early on, and also you see, I mean, they did eventually incentivize people. But you do also see a big difference in terms of what the attitudes were about voting shares, options, huge grants, and things like that to move a lot of the wealth from people who are putting up the capital to people who are running it. the most successful car companies, other than what we're talking about with Ford, right, did not get wealthy to the same extent that in some other industries. I've said before, like looking for what's a good industry, what are the industries in which people have made fortunes? Is often a good indicator of that, because it does give you an idea of like really what the long-term returns are in the industry. We talked a little bit about return on equity or something, but say in cable, where you can't really measure it through their growth phase, it did at least get the people who were involved early on very rich, although they used a lot of debt to do it, right? So I think it's interesting from an investment perspective to look at it that way, because sometimes a company is very successful, GM's very successful, but if you look at the phase of how they put the company together, it involved issuing a lot of stock to a lot of different companies to put it together. And in some cases, probably people whose companies turned out not to be worth that much ended up with about as much skin in the game as some people who had big contributions.
Mm-hmm. Isn't it also fascinating how, like Tesla, for example, they have their own charging networks, and we're the first people doing electric vehicles, at least in modern times. And now all these other auto manufacturers are doing electric vehicles. And not only that, but Tesla, since they've had this first mover advantage, now these other manufacturers are going to tap into Tesla's charging stations as well. So when Jacob was talking about Bezos, having 8 years ahead, and we were talking about, GM being different than Ford because Ford was stuck in their old ways. It's kind of similar to now, like all these other manufacturers are going to have to use Tesla's technology for, their own customers going forward. So I don't know, like there's this balance maybe of like not having too much inertia versus still being able to innovate and come up with new products and stuff like that. But it just shows how hard all of this really is.
Yeah, and I think the car industry has been an interesting story for like 100 years. It's fun to watch, fun to study, but I still want to be on the sidelines today as an investor. And I think looking back in all these periods, probably want to be on the sideline the whole time. But it's still fascinating story for how old, I guess, by now it is.
Geoff, could you ever see yourself investing in a car manufacturer?
I mean, maybe at the right price, right? But
yeah.
I don't know about
stress
that
situation.
Yeah, I mean, people always say how like auto parts businesses are so bad, and that they buy into the auto makers a lot of times. But I was looking through the Japan Company Handbook, for instance, and so you see all the different companies that supply Toyota and stuff, and in a lot of these industries, a lot of the ones who supply these companies don't have much worse results, not much better either, but not much different results than they do. It's not like these companies have been able to capture all that much of the value chain. The finance thing, the dealer things, and see, they haven't been able to own the dealers, in the United States, and some of them had finance arms that they don't have anymore. So there might have been more opportunities in that stuff. We didn't talk about it, but what's one thing that's really different at this part of the history of cars compared to later, and that's made cars a tough business, is that models don't last very long as being very successful. If you look at the top most successful selling vehicles for different companies, they quickly drop off that list. So in this period, like the Model T, that's a rarity. Later on in history, it'll be extremely rare. There's some pickup truck that's sold for decades as one of the top things in the U.S. But like for most of the most popular passenger vehicles, they don't stay up there that long. And it's an interesting question as to why that doesn't happen. Is it variety? Like we talked about, once so many are on the road, does it have a certain positioning? Okay, so now the minivan is only associated with soccer moms and stuff, and now I don't want that car. Is it, what is it? But there are these cars that sell really well, and 10 years later, they've stopped production. And that's a big deal, because when we talk about movies and things, if you have Marvel things and then 10 years later they're not gonna be in theaters at all, that makes the business a lot worse. And so I remember in the Business Adventures book, there's a bit there talking about Ford and some things that way. But one of the things it talks about is going through the list of like how long a car was successful, how long it sold for, and how short the lifespan of some of these cars that we remember that were so popular, the most best-selling car in America, and then a few years later not selling that well. And it just reminded me of that because we talked about electric cars. Tesla is a rarity that way. A little bit Toyota with their Prius, with the hybrid, also sold a lot. That was one car. But in focusing on very, very few models, right? But historically, that's been tough to continue for a long time. And that would make the business a lot better, right? If Ford could have, whatever, 30, 40 years ago, just sold a Taurus, just sold the Taurus in huge numbers, right? And it continued as a business. It's the durability.
For these, and maybe it is. GM talks a lot about from this period about
variety, you know, and I just get the sense of a lot of experimentation, trying things out, and you get a feel for customers' tastes and everything. And it may be that in cars there is a real desire for variety, not to have the same thing all the time. It seems to be something that changes a lot. Even when we haven't had a lot of technical change, you can look and see the difference between what cars are popular in one decade and the next. Just it's almost like fashion that way, you know, because there isn't. These things are very, you know, aside from where we're talking about electric and stuff, you know, for the last several decades, the major car makers are making cars that are very, very similar to each other. And yet we can look at them and tell what years they're from and everything, just in terms of it is fashion-like, that in terms of clothes or something. You could say it's very commodity, but there is this cycle there, whether it's a fashion cycle or a economic cycle or whatever, but there is experimentation with customer taste going on there in a way that I don't think you see with... to the same extent with like food and beverage and a lot of things that Buffett loves. It just doesn't seem to have the same lack of variation over time.
And maybe that's why Ferrari, you know, the scarcity of Ferrari, they don't make too many of them. And then also not many people can afford them. Maybe, I guess, those two things go hand in hand, where maybe that's had a little more durability because of the scarcity of it.
Yeah, we didn't talk about that. We've only talked about, you know, the major car companies that make huge numbers of cars. There have been some cases of companies, and specifically families, when I was talking about families that made a lot of money, has been in much lower production and focus on really building a brand, which is very different. You know, we talk about, you know, comparing a Ferrari to a Ford or a Porsche to a Volkswagen or whatever. Just the scale involved with it is totally different for the companies we've been talking about.
Which model do you like more? The Ferrari model?
I think there's the possibility for, how do I put this? I think there's the possibility for the manufacturer to be capturing a lot more value that way as a brand with the positioning, kind of like what I was talking about. It's interesting because when people ask me about car dealers, they notice that I was interested in buying car dealers that are much more mass market and had a variety of different brands. And that's true. And the reason was I didn't want to bet on any one brand. You know, if I was buying affiliates of a, TV networks in the 70s or 80s or whatever, I would want someone who had a bunch of ABC affiliates, CBS, NBC. I don't want to bet on one or the other. I would just want to have that business there that way, right? And I think that's the kind of advantage for dealer groups. They may not be great businesses necessarily, but I do think that in the long run, they may be more durable, actually, than the car makers. And it is interesting that for, you know, it may be someone else who bought into, you know, GM with Berkshire, but we do know that Berkshire bought, that Buffett would have been the one that bought into a car dealer, you know, bought the whole thing. And so it is interesting that there's parts of the industry that they'd be willing to buy into. And I think that's a consolidation thing, a durability thing, right, about how he thinks about that. But he didn't, you know, he didn't buy into GM and Ford and stuff in their times of trouble the way that he did some financial companies or General Electric or some of the other brands that he bailed out and everything. So I do feel like it's a durability thing rather than like a quality, like that you can never make good returns in this industry because, like we said, in this early period, they're making good returns, and GM decades later would be making really high returns on equity. But I think Buffett's probably worried about the durability of it. Like you're saying, just like the change in the industry.
So whether it's still going to be around in the same fashion 10, 15, 20, 30 years from now.
Whether the leaders are going to be the same or there's something that you can't predict that will change things, that's what worries me about it. That's sort of how we started this whole discussion with talking about Ford and like the idea of just a low cost advantage. It does worry me that you don't know what that will be. You see that a lot with some technology things early on when we were talking about BlackBerry and stuff, right? It's hard to tell because at the time it might sound like that is a big advantage to have. Like, how do they ever overcome that advantage that Ford had? There's so many more of them. Think about probably what the total cost of ownership would be and everything. But then look at it from the other side and say, okay, think about the element, being exposed to the elements and everything. Think about having to start the car yourself with a crank that way. Some of the things are huge differences where people might have been very willing to pay up for it, seeing it totally differently. I mean, if it had stayed the way that the Model T originally was, I don't know if it would have appealed to as many people. There's some people who'd really be willing to pay up, and the car as it existed later is because of how convenient it was, how much more comfortable and pleasant an experience it was. And it might be that there was more of a hobbyist thing that they're describing at first with the Model T, and that's why people were skeptical of it, right? Just like when we talk about electric cars, early on, if they have no range and it takes so long to charge them up and all those things, it sounds like you think, oh, well, this is a niche. And, Ford was totally dominant in the early stages, right? But I don't know if the Model T was the right car for years later, but it was the right car to get the industry started,
Well, very good. Well, you should definitely go listen to the 10K podcast. Jacob has 3 episodes where he goes more in depth on this topic. One of the podcasts was 30 minutes, and then the other 2 were basically an hour. So I'm going to put all of that information down below in the description. Jacob, what's the next company that you're going to profile for the pod?
By the time this comes out, I think I'll have National Cash Register out, the 1906 annual report. So in Poor Charlie's Almanac, he talks about John Patterson and National Cash Register. It's a pretty awesome annual report, so looking forward to that one.
Very good. Very good. We will put all of Jacob's information in the description, so go check out his podcast. But I want to thank everybody so much for tuning in with the 3 of us on the Focus Compounding podcast today. Make sure you hit that subscribe button wherever you are listening and watching. And be sure to check out all of our content on the internet. Go to focuscompounding.com to get access to investment write-ups. Follow me on Twitter at FocusCompound. And of course, follow Jacob on Twitter while you're at it. And we will see you next week. Thanks so much for tuning in. Take care.